I'm Paul Morrow, Smart Financial. I'm the author of Smart Financial Grandparenting and Smart Financial Longevity, which is out this January. They'll be on Amazon, and you can go there and look them up and download them. I want to talk to you today about one particular case. As many of you know, I ran a financial practice for the last 50 years. I don't take personal clients now. I advise advisors and do this little storytelling about what we've done the last 50 years. I have a great story about long-term care I just want to fill you in on. Long-term care is such a stress-related issue for a lot of people, especially when you consider the fact that a lot of us are going to age and we're going to add that extra years onto our life that Stanford University calls the longevity dividend. But some of us may spend the last few years of our life not particularly healthy, not able to take care of ourselves, and perhaps even in a facility where we have to be cared for. So, how do we handle this sort of thing? Well, long-term care insurance has been around for a long time, and it's got some issues. The problems behind long-term care insurance are well noted, and again, they're in my book. You can read about it, increasing premiums and all that sort of thing, and difficult to qualify for. So we had a fellow come to see us, and this is another real case study from our practice. He was a wonderful guy, very successful business guy. He had a few bucks, and he was worried because he just went through it with his own parents, and he paid out about $1 million in long-term care expense. Now, that's not unusual. I personally, and with my brother, managed a long-term care experience that was about 8 years. So all this stuff you read about people being in a nursing home for 2 years is kind of bunk, because they don't go to a nursing home first. First, they do health care at home, and then if you go to a good nursing home, they extend life quite a bit. So, it is a very large, substantial paycheck that has to be written to caregivers. So what do we do about that? Well, obviously, very affluent families in America don't concern themselves with this. They just write the check. It's another bill they pay. Very low income families and families of modest means, they don't have to worry about it either. There's a program called Medicaid. It's a financially qualifying program that takes care of them. This is a middle class problem. Again, when I say middle class, if you have $1 to $20 million, right, this is basically a problem of some significance because, no matter how you count it, $1 million is $1 million. So this fella came to us, and he was what I would say at the upper end of, that affluence. And he had some cash, and he had some health issues in his past. And obtaining traditional long-term care was a big problem. So we looked at the ways that we could get what we call leverage. So this is one of the chapters in the book, and it's just about getting long-term care leverage. Anytime that you can pay, say, $300,000 to get $900,000 of long-term care benefits, that's leverage. In this particular case, we used a product for him that didn't have a lot of stringent medical requirements. It was a single deposit program. This guy took $300,000 from his bank account, basically, and he deposited it into this long-term care certificate account. Now, they write them with insurance companies and annuity companies and all that, and everybody has to qualify on their own to get one. But when you open one of these accounts, the good news is you make a deposit. You're getting some interest in the bank. You might get a little bit less interest when you deposit it to one of these long-term care accounts. But in the event that you need long-term care, that $300,000 will pay $900,000 of care in his case. That is a huge amount of leverage. That's 3x leverage. And, if you're a decent financial person or investor or business person, leverage is super important. So the big thing about it was, the big bus problem. People thought they'd buy these things, get hit by a bus, and the family would never get the money. Well, these kind of programs have a death refund. So you can deposit money, you can get the security and the sleeping pill of knowing that you have some leverage on the long-term care. But if you get lucky and just die in your seat like a Disney movie, then that $300,000 is paid back to your family. We love the synergy of being able to cover a risk issue and not lose your money. So if you're interested in ways to cover the long-term care issue, you should use the example of our friend who just did this. And if you have some excess cash and it's sitting in the bank, remember, there's the difference between paying $1 for $1 of care and the difference between paying 30 cents for $1 of care. That's what we call leverage. And we're happy to help you. Contact us online, reach out to us at Smart Financial, info@smartfinanciallifestyle.com, and we'll do our best to help you. And join us for one of our online webinars about this in 2025. I'm Paul Morrow. I look forward to seeing you there.